Okay, and this week's podcast episode is what makes a great pitch deck. And I'm so thrilled to introduce Steph Nasser, co-founder of OpenVC, which is an open platform that allows tech founders to connect with investors. OpenVC provides founders with an investor list, a fundraising CRM, and a deck hosting solution for free. No commission, no subscription. Today, OpenVC drives deal flow for over 1,000 VC firms, angel networks, and corporate funds. Every week, over 150 pitch decks are sent through the platform. Steph, I'm so thrilled to have you on the show, man. This is great. You're on the other side of the world, and I know it's evening there, but thank you for joining me on the show. This is awesome.
Thanks for having me, Richard. I'm very excited to have this conversation together.
All right. Okay, Steph. So let's delve in. It's obviously a big area, but let's talk about, as regards pitch deck, purpose and storytelling, Steph. So what's the most critical element of storytelling in a pitch deck that resonates with investors?
There are many important parts of the puzzle, but the one that I think makes or break very easily your pitch is the hook, the kind of first slide, first impression. And that's just because so many founders would open their pitch deck with, talking about themselves. Hey, this is the problem we're solving. This is who we are. This is what we do. And that's important and it will come in due time. But personally, I feel that what's super important is telling investors, hey, this is why you should care. And taking the time to build that connection with the audience, even if it's, through a slide, through a PDF, you want to have that little moment, and it can take many forms. It can take like, hey, look, there is this big business opportunity going on. There is this big shift in the market. There is a technology leap that is happening. Um, there is a reason to care, and there's a reason why you should care as an investor. And then from there, you can, and this is why we're building this. This is why there's an opportunity, and then you can unroll the whole game plan. But I always really believe that this hook is a core truth, and is a core truth, for any deck of any type. I mean, I focus on fundraising, but sales deck is going to be the same. Start off strong, and a lot of founders, just because that's what we teach you in school, right? You have a very structured approach and you end with the strongest point. Pitch deck is kind of the opposite. Start strong because you just have a few seconds to capture people's attention. And then after that, once they're on board, they're on the train, you're driving the train, you take them where you want. So yeah, start with a strong hook.
Oh, what a strong hit. And what's your view, Steph, on the attention span in that first, period? Some people say it's 10 seconds, some people 30, some people may say what's your personal view of you got to get a strong hook, otherwise, and you've got the group of
Yeah.
investors, they've probably seen, hundreds of pitch decks in a short period of time. What's the attention span, do you think?
It's short. It's
Okay.
definitely short. And it's only getting shorter. It's kind of a TikTok attention span. I mean, TikTok is shutting down now. So whatever, YouTube Shorts, people scroll and swipe, or Tinder if you'd like. So it's really about having that, I don't know, that spark, right? That, okay, I want to dig in. I want to swipe left and dive in a little bit. There is, I think, a misconception on that point because, we all know those reports telling us an investor spends on average 2 minutes and a half on a pitch deck, and you would see different reports quarter per quarter. Yeah, Q3 it was 2 minutes 30, Q4 it's 3 minutes, so now they pay more attention and people try to read between the lines what that means. Um, but there is a massive misconception here because these are averages. What it means is that 90% of decks get 20 seconds of attention and 10% of deck gets, 7, 8 minutes. And so people need to keep that in mind when we deal with averages. And so, yeah, the truth is it's going to be, yeah, less than 30 seconds for sure. Most investors will not even reach the end of your deck, um, just because it's too long and they just drop out at some point. So you definitely want to have something. Um, This is one of those things you have to get right the first time. In startups, we always say that you can iterate and you should, um, build, measure, learn, and iterate. But with a pitch deck, you only get one chance to make a good impression. So you cannot have this approach with your deck. It has to be really solid from the get-go.
So Steph, if you can provide an example, great, because I know there's a surprise question, but if you can give an example of a really strong hook, or how does a potential person cultivate a really strong hook? What would make for a really strong hook?
Okay. So the hook, by definition, you're hooking someone. So you
Yes,
have to know the person, the recipient of that hook, so
yes,
the investor. And so the first thing is, okay, I know that I'm going to talk to a SaaS investor in the US, right? So what does a SaaS investor in the US care about? And I know that this person in particular, for example, has invested in, I don't know, uh, product data warehouse, something like that.
yeah,
Whatever, it's a software category. And let's say that I see that there's a market shift from this historical legacy category to a new emerging category. And my startup is positioning itself on this trend, surfing this wave. So I would probably open with that. I would probably open with, hey, the product, what did I say? Product data warehousing
yes,
software is being replaced, at a 50% per year rate by this emerging category. And then I know the guy will pay attention because he has three investments in that space. And because he probably knows that because he's an investor in that space, so he's very aware and he's gonna pay attention. So anything that can signify that there's a window of opportunity, it's large, it's venture backable, right? There's a space for to build $1 billion company in that space. And so change in the law, like okay, for example, I'm delivery, this was a hot category at some point, weed delivery on the West Coast, you know.
yes,
So okay, the in 6 months, weed will be legalized and there is no distribution network, right? So and that's the hook. And then, okay, we're going to build that infrastructure. In Europe, it was with GDPR. Okay, there is a new set of laws coming into force, and you know, 100,000 companies in Europe are not compliant, and they're going to have to be compliant in 12 months. And we're building the software that will solve that pain point for them. So I'm not starting immediately by, okay, companies have to get compliant. I'm starting with, okay, I'm starting with a story.
yes,
I'm starting with a crisis, right?
yes.
There is something happening. And then we fit somewhere into that story. But there is something bigger than me, bigger than the company happening in the world. And because you know who you're talking to and you know that they're aware of that, because it's a small world and everybody in that space is well aware and well informed, you will appear as credible, you will appear as informed, you will appear as a peer to that investor. So, okay, we both care about the same stuff. We both look at the world through the same angles. And so whatever is coming next is probably going to be relevant, right? So you want to put the investor in that mindset. So yeah, hinting at changes that you're gonna take advantage of is usually a very, very strong hook.
Awesome, awesome. That's great advice, Steph. Thank you for that. And we'll talk a little bit about, addressable markets later on. But you raise a really good point, Steph, about taking the time, excuse me, to really understand your audience. All right, and what matters to them and what's important to them. What are some of your tips about how you kind of get into the mind of the investor and understand what's important to them?
So that's the good news. It's pretty easy because most investors care about the exact same things. Okay. When you talk to an investor, they will tell you different things. They'll all tell you their own little different story because they all have different personal brands. But at the end of the day, they all care about returning 30x to 100x, right? So if you're talking to a seed stage investor and they're going to invest $1 million in a company, they want to return, depending on the fund size and some parameters, 30 to $100 million on that 1 million within 7 to 10 years. That's the basic math of venture capital. And so once you know that, that's kind of the end game, then you can walk backwards and reconstruct the things that they care about. The market needs to be large enough to support $1 billion exit, right? The capital efficiency. They're gonna want a model that is very capital efficient. So software is great. Biotech, not bad. Um, Restaurants, not so good. Anything that requires, facilities and a lot of staff, not great. We want something that has a very low marginal cost. So
Yeah.
software is great because you can just copy paste. You build once and sell 1 million copies. And so just like that, and there are, like a boatload of those criteria, right? And if you just know these basic criteria, which are common to all investors, then you can pre-qualify yourself and say, okay, yeah, I tick that box, I tick that box, I tick that box. That one, maybe I need to adjust something in my pitch. And then you have a VC compliant pitch deck that can raise funds. And you're right to point this out. Some founders, especially first-time founders who are not too experienced with this kind of stuff, they don't realize that what they're pitching is pretty much unfundable because they're pitching a small market size,
Yeah.
and maybe the project is great and everything, but it just doesn't fit in the spreadsheet of the investor, right? It doesn't work with their model. So it's important for founders, especially those who are new to the game. It's important to do your homework and understand what investors care about.
Love that, Steph. Love that. So, power of the hook, power of the story, know your audience. Okay, are the three key takeaways. So let's talk a little bit about that first minute or two and the risk of overwhelm. So, how can founders effectively convey their passion and vision without overwhelming investors with too much information? That's always a catch. I've seen that in my career.
Yeah,
People want to dump everything in there to make sure they've covered all angles, but
yeah.
brevity and clarity are key here.
That's a hard one, and I still struggle with that one. And someone said something on LinkedIn that I kind of, light up how to say in English, light up a bulb in my head. Like, okay, yeah, that's true. He said the problem with founders is that they believe that if I explain enough, they will see, they will understand, they will see what I see, they will understand the opportunity. And so they feel that the only thing between them and funding is that didn't, they haven't explained enough
Right.
because they are so convinced of their own story. They say, oh, maybe that part of the story wasn't clear, or this part I didn't mention. And so I feel it's a matter of adding and adding and adding until you have kind of transferred all the content from your mind to the investor's mind, and
Yeah.
they can reconstruct that same picture in their mind, and then it will click and they will invest. That's not how it works. That would be great. It's not how it works. And so founders are usually notoriously bad at doing what you're describing, which is trimming down and just taking a like high level view, focusing on the key messages. So my advice is one, look at good decks and learn from them, right? So if you look at great decks from great startups that raised, you will see that indeed it's pretty lightweight, it's pretty high level and inspirational. I mean, there is meat, there are facts for sure, but it's not overwhelming. Two, get help. So surround yourself with advisors, surround yourself with experienced people, um, and just run your deck through people who have done that before and get some advice. Like it's okay, it's unpleasant, and it's a long process. And also a lot of founders they just don't want to do that because they spend so much time building the deck and adding, adding, adding. And when they finally manage to cram everything into these 20 slides, they want to rush to the investor. But that's the moment when no, there's a second part, which is when you cut, 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 cut. You've been adding, adding, adding. Now you're gonna remove to just keep the most, the core stuff. There's a French author, I don't know if Americans know that sentence, but it's famous in France, said that perfection is not when there's nothing else to add, it's when there's nothing else to remove. That's Saint-Exupéry from The Little Prince. Um, I mean, he didn't say that in The Little Prince, but same author. Great guy, fascinating story,
Yeah.
but it's for another day. So it's something that is counterintuitive for most founders, unless they have a background in marketing and they understand that really well. But for most founders, this is alien concept, and the best way to do that is to look at better decks than yours and get advice, get help. Yeah, get roasted, get your deck roasted by more experienced people, and that's very easy to find out there.
And what would be a good source, Steph, to find out? Because I've come across many founders who would love an example and what good looks like for a pitch deck. Can you give some suggestions to the audience as
Yeah.
to where they can find some good ones, you know?
For sure. Okay. So, shameless plug, but on OpenVC, we have a free tool called OpenDeck, opendeck.app. And so you can go to that website. There's no sign up, no login. It's an open page. And you can filter and say, okay, show me team slides. And it's going through 200 examples of real team slides from real startups. And you can see different approaches. You can see how people made their slide, designed them, and you will pick and choose because you don't need to reinvent the wheel, right? It's been done before. Just just make that extra effort to look at, like, select 5 great slides that you like, and if you have a little bit of taste, you shouldn't get it wrong, and then build your own, and just that process of analysis synthesis will also help you even think on your own project. So that's one thing. So that's for the source, and then for the roasting itself, you can post your, and maybe don't post your whole deck on Twitter, but post slides, be public about your quest for feedback. People are always eager to help. I mean, I spend a lot of time helping people who just DM me, ask me for support, have some questions. Not charging anybody for that. So just don't stay in your corner because it's comfortable.
Yeah.
You're not going to improve your deck if you do that.
Awesome, Steph. Let's talk a little bit about striking a balance between too little and too much. So how should the structure and focus of a pitch deck evolve from early stage startup and seed funding, particularly if they're seeking growth financing?
Okay. So from, let's say, early stage to growth stage to late
Yes.
stage,
Yep.
it's not, well, the main difference is going to be, imagine a line, an axis, and on one end is going to be quantitative stuff, numbers, metrics. And on the other end is going to be storytelling, vision, mission, inspiration, emotions. Uh, well, the early stage is more on the emotion side,
Yes.
and growth stage is more on the number side, right? Because the more you go from like pre-seed to seed is kind of in the middle, and Series A gets definitely closer to numbers because that's when you're supposed to be selling numbers. You're more of a company and less of a project.
Yes.
So this is going to be the main difference. And so decks, as you move upwards, are thicker, denser. You move from, kind of keynote style to corporate style, like investment banking stuff. Yeah, the stuff that nobody likes, but that is necessary. So that's going to be the main difference. And the person making the deck is not going to be the same, right? When you're raising Series D, usually you have staff, you have a CFO, you have maybe an investment banker in your corner, or, you know. Um, when you pre-seed, you're doing yourself. Maybe you spend $50 on a template, and that's pretty much it. So that's also a big difference.
I love that continuum. Now we're really warming up, Steph. I love this. All right. So are there any specific slides or sections that are universally essential regardless of the company stage?
You need a cover slide. You need a cover slide. You need a back cover at the end with a call to action. But I guess that's not what people want to hear. The team slide is important for different reasons at every step of the way.
Yep.
Obviously, when you're at very early stage, the team is the company, the team is the market, the team is the traction, the team is everything, right? Because it's the only thing that will remain even if everything else changes. So you can pivot 3 times. The team is supposed to still be in place. So that's why the team is so important at early stage. When you move towards growth stage, the team still matters, but it's gonna be about showing your ability to attract top talents.
Yep.
So if you look at the Series B or Series C deck, and I'm looking at the team slide, I want to see, you know, very competent, very qualified people. I want to see that you have your C-suite is composed of very experienced marketers, technologists, salespeople, etc., etc. So because at this point, when B, C, D plus, you're supposed to have an org chart, and it's not just two founders anymore. It's founders. You have a couple of C-level people. You have some heads of or some VP of, and you want to show that you have world-class talent. But at the same time, relatively speaking, the importance of the team decreases because, like we said before, the financial part, you know, grows in importance. So, but the team slides always remain important. Apart from that, I mean, I guess that's the only constant, right? Because the rest, I mean, I can imagine some extreme cases where, I mean, you could race just on a team. It's rare, but it happens.
Got it. Okay. All right. And you'd mentioned before, obviously, we're talking to investors and they're looking for a return on investment. So there's got to be, irrespective of stage of maturity, there's got to be some numbers in there. So what metrics or data points do investors prioritize at each maturity stage, would you say?
So, okay, so stuff that they're always going to look at, obviously, is how much you're raising, the round size,
Yep.
and within that, how much has already been secured, because
Yep.
investors hate being the first to invest.
Mhm.
So they want to receive a deck that says, hey, we're raising $2 million, whatever, and 50% is already secured with investor A and B, right? And so they feel comfortable that they can join the table and they're not the first one taking a bet on you. So this is going to be the first, I'd say if you look at the ask, you have a slide that we call the ask, right? Or the fundraising,
Yep.
where you say, okay, so this will be the two numbers that matter. Sometimes people, they have this kind of pie chart and they show, okay, we're going to spend 30% on marketing, 30%
Yep.
on whatever. Honestly, this is for early stage at least, this doesn't really matter. It's always going to be the same. It's going to be 30% marketing, 30% sales, 30% tech, and then 10% safety margin, right? Buffer. And
Yep.
it's always the same thing. It's inconsequential. So I don't even care about that. You want to have that conversation later during due diligence, maybe, but not in the first date. I don't think it's valuable. So that's for that part. Then if we're looking at two other types of numbers, you're going to have the numbers on the traction side and numbers on the market side. There's a lot to say here. I don't know if you want me to deep dive or how do you want to do that? Because there's a lot to unpack.
Just a level below that, not too deep, but just a level, just to whet the appetite and bring the awareness to the audience.
Okay. Okay. So very simple. The market should be big and should be
Yeah.
growing.
Yeah. Awesome.
Is that high level enough?
Yeah, maybe go one step down because it's very important. We're going to
Okay.
hit the Tam and Sam in a minute, but go ahead.
Yeah.
Keep going. Keep
Yeah.
going, Steph. This is great.
So if we're talking about the market should be big enough, what does that mean? We usually break down markets into TAM, SAM, SUM. So TAM is the largest one, SUM is the smallest one. I'm simplifying.
Yes.
The one that investors really care about is the middle one, the SAM, serviceable available market.
Yes.
And common knowledge, common wisdom wants this number to be above 1 billion USD. Okay. And I'm not gonna go into the math here, but just make sure it's above one so that the VC analyst can check the box
Yeah.
and you don't get disqualified for that. It's also important to be on a market that is growing.
Yeah.
So for example, if you're in the cloud space, cloud is growing 20% per year. That's not bad. But if you're in the LLM market right now, it's growing, I don't know, 3 digits per year. And so it's even better because if you just have a product, even if it's just pulled by the market, doing nothing, it's going to grow naturally. So it's always encouraging. You don't want to be on the shrinking market. Yeah.
Yeah.
So that would be on the market side. And then traction, you want to show typically traction, there are many layers to it, depending at which stage we're at. But the basics is going to be number one, retention,
Hmm.
not growth. Number one is retention. Retention is king. So people use your app, people sign up, people download your app. Cool. How many are still using it 6 days later, 6 weeks later, 6 months later, right? Because otherwise you just, filling a leaking bathtub, or I don't know how you say it. And so there's no point because maybe you're spending a lot of money to acquire people, but they're not staying.
Yes.
So you want to show that you have good retention. That's number one. And that will depend on your business model. If you're a SaaS company, SMB SaaS, your monthly churn, if it's above 5%, is maybe too much. If you're social media, maybe you're going to look at daily active users or weekly active users. I don't remember the benchmarks, but I think it should be above 25%. I'm not too sure. For e-commerce, you're going to look at returning clients and the average basket. So this kind of stuff. Number two, growth. So that's the one that most people think about when they think about traction. And show that it's going up and to the right, right? The hockey stick
Yes.
graph. And the third one, which is less discussed but also important, is basically meaningful usage. So you want to show that people using your product, and I'm assuming we're mostly talking about software here, perform a meaningful action. Defined depend on your business. So for Facebook, for a long time, it was liking. If they like a post, because okay, they took a minute, or if they post something, it's a meaningful action and they got value from the product. Because if they just log in and then they close the app, it doesn't really count. So retention, growth, and usage. These are the three dimensions we're looking at to determine traction. And then, like I said, depending on your model, there are different benchmarks, and you should be aware of that. If you're doing enterprise SaaS or a dating app, the expected numbers are going to be different. And as a founder, it's your job to know what numbers investors want to see.
Awesome. Awesome. I love that. Okay. Let's talk about a bit more about content and design in this section here. So, the value proposition and differentiation is critical, as we all know, Steph. So, what are the key elements of a compelling value proposition slide, and how can businesses make that differentiation stand out?
So when I build decks, and everyone has their own little habits. Huh? I don't have a value prop slide. What I do is I'm gonna have a problem and a solution slide typically, or opportunity and solution, depending how you want to frame it, because there doesn't have to be a problem, right? If you're selling a social media app, there's no problem, right? It's just there's an opportunity and you're going after that opportunity. So for me, it's like those two slides put together, that's my value prop, right? So here, ideally, what you want to show few things. One, you want to show that your value prop, defined as the intersection of problem and solution, is aimed at a specific segment or audience or niche or target or whatever you want. You don't want it to be too broad because, again, it's like the SAM should be above $1 billion. If you're gonna sell to everyone from 18 years old to 88 years old, no one's gonna believe you. You're not gonna, I mean, it just doesn't make sense. It's ridiculous. So you should know, okay, we're solving one problem for one specific demographic that we can precisely define. That's number one. Number two, ideally, you can quantify the benefit.
Yes.
So say, okay, we're selling to, those big banks and insurance companies, and we know that based on some pilots we run, they get X million dollars in savings, or we generated X% more margin for them.
Yeah.
So if you can quantify, put a dollar number on your value prop, it's great.
Yes.
There is, I really like this slide. There is a deck from one of those fake meat companies. I forgot which one it was. Lab grown meat. And they have a really great slide where they show basically they kind of break down the burger, and they show that the burger made out of a lab meat today, I think the meat itself is like 4 times more expensive than normal meat because it's still more expensive to grow in a lab. And that's the whole value prop is, yeah, we make good tasting meat, safe meat in lab that is, competitive with real meat today, price wise. And that's great because now there's no debate about, okay, is there a value prop? Is this valuable? Yeah, it's valuable. We can put a price tag on it. You don't want your value prop to be up for debate. You want it to be something that people can fall behind and not argue with you about. And so for that, you want one to be specific about who needs it. Because you cannot, an example I like to give is this one. If your problem statement is, okay, uh, flying, on a plane sucks. Maybe it sucks for you because you're students and you're traveling, economy class in a cheap ticket. But for, I don't know, for another person flying first class, it's very enjoyable and actually it's a great experience. So if you're solving that problem, be specific. Flying economy, long haul sucks. And then suddenly people will say, yeah, of course it sucks. And then let's see what solution you're bringing to that problem. But so you have that the ability to be specific is very important, and then the ability to quantify the benefit, ideally dollar number, alternatively in hours, right, or in percentage or whatever it is. But the closer you are to money, the better.
Yep.
And if you have those two things, honestly, you're in a good position. And like I said, the last thing is you don't want something that people will argue with. You don't want something. I try something I see a lot, and I'm not a big fan. And it's a bit sad because it's for mission-driven companies, right? A lot of companies will tell you, in their value prop, yeah, we're going to, something around the flavor of make the world a better place, right? Yeah, there is something is unfair, something is unjust, and we're solving that. And it's great, like, philosophically, but from a business standpoint, where do I make money? And and investors will not tell you that on LinkedIn, right? They will not tell you that in a Twitter post because they have a personal brand again, but that's what they think. And so it's great that you have this mission and stuff, but try to have a problem solution or value prop that is pretty grounded and simple. Don't be too esoterical. Don't be too, philosophical, right? There is a clear, simple problem. Don't use, oh, and the last one. Can I swear? Is it allowed to swear on the podcast?
Not really. I would
Not
prefer.
really. Okay. Yeah, I'm French,
Yeah.
but I'm the guest, so I'll follow the rules. Don't use, then I don't know how to say it in English. Um, you know, let's say corporate jargon,
Yes.
right?
Yeah.
So, we are transforming the revolution of Industry 4.0. Nobody understand, right? We are disrupting whatever. No, no. Be simple. We automate a manual task, whatever it is. In the banking industry, we automate Q&A for the back office of corporate banking.
Yep.
Okay, now we understand. And we do that, and a task that used to take 3 months and 200 people now is done in 3 days and 5 people, right?
Yep.
That's a value prop. That's an exciting value prop. But people sometimes they just fall victim to the storytelling that they hear from investors and the press in general, and they think they have to paint a big, story, romantic story. Keep it simple.
Absolutely, Steph. I love that. No, thank you for that. That's awesome. I mean, now we're coming down from almost an aerial view of the storytelling now to more specifics in the value proposition, right? Fabulous. I love that. So how much emphasis should be placed on competitive analysis, and what's the best way to present it?
So there are two school of thoughts. One school of thought that says that competition doesn't matter. You're a early stage company. Everybody's bigger than you anyway. And you shouldn't care because you will not die from your competition at early stage. You will die from a million other things, but you will not die because, company X launched a competitor, right? Um, so that's one school of thought. And then there's another school of thought that says that if you are a founder in a space, if you're building, I don't know, the next Salesforce or the next Palantir, then you should be the world's best expert on that space. This would be expected, right? Because otherwise, why would I invest in you if you don't even know your competitors, which is something super basic? If you're really trying to build a best-in-class product, you must know all your competitors' products. If you're trying to, win customers, you must have studied your competitors' marketing strategy, what channels they use, their acquisition costs. So the the logic of it is that if you're doing your work seriously, then you must know your competitors very well because it's not possible otherwise. If you and it makes sense. I think it's kind of both. I do think that like if you come to me, you're saying, yeah, I'm building that space and I know that space better than you, that's a red flag, right? That's just not acceptable. Like
Yep.
I'm not gonna invest in a space in a company if the founders cannot teach me something about that space and give me some extra insights that makes it okay. This guy knows because he knows more than me, and so he puts me in my place. He puts me in the back seat, and now it's okay. He's the driver. I'm in the back seat. I feel like I can trust him. It's not necessarily rational as a way to approach things, but we're human beings, right? And investors are human beings. And so honestly, it's also a matter of ego. If you can keep an investor's ego in check, if you can teach them a couple of things they didn't know about that space, that's interesting. I've been in a meeting in a pitch session. It was a deep tech startup, and the product, let's say, it's a life science tool, so very technical stuff. And of course, in that space, and scientists are very proud people. They think, yeah, I know my stuff very well because I've done a PhD in that space, etc. And so it was a biology problem that they're trying to solve. But the founder was a physicist, and he was solving a classic biology problem with a radically different approach using physical properties, using electromagnetism, which was completely like flipping the script. And the investors were super curious and super annoyed and super humbled because they, they couldn't say, oh, but we know these guys in Singapore are building a similar tech. No, because there was no comparable. It was a kind of unexpected approach, let's say non-consensual, not standard approach. And I think that's what you want, right? You want to get on stage and slap them in the face, metaphorically, and then say, hey, there is a big opportunity, the hook, and we have an approach that is differentiated. So back to your question. Sorry, I went a bit far, but
Good.
back to your question. I think you should definitely know the space cold. You have to be really good at that. And then you should not worry about it too much because, like I said, you're not going to die from it. So you should not obsess about it out of fear, but you should just make it a tool of your processes. Okay, I want to know what's happening on the market. That's just one brick in the wall in my toolbox as a founder.
Got it. Okay. All right, Steph. Wonderfully said. Thank you. Let's talk a little bit about financials and projections because we are talking about investors here, and they're going to obviously want to know about the money side of this. So, what financial metrics are most compelling to investors, at each business stage, and how should these be visually represented in a pitch deck?
So let's start from the end. The best one is DPI, obviously. They want to know, how much cash they can make for the LPs,
Yeah,
real cash, not paper money. But that is for 10 years down the road.
yeah,
So realistically, more seriously, um, we're gonna want to look at a few things. We're gonna want to look at. Hmm. So I'm conflicted because, depending on the year, I wouldn't say the same thing.
really?
Uh, Last year, people looked at profitability a lot
Yeah,
because it was a bad year for VC. It was a bad year for everyone. Uh, 3, 4 years ago, it was much more about top line, revenue, this kind
yeah,
of stuff, and showing that you're growing aggressively, even if you're burning cash. Actually, it's better if you're burning cash, if you're digging a hole because you're going to need to raise more and more, and it's going to create more opportunities for upside. So, um, this is kind of the two things. But I would say, like, if I just take a step back, it's going to be about showing a path to being a unicorn. And this is pretty standardized today, right? So I received the deck. I think it was yesterday. I saw a deck, and the person announced, I don't know, $100 million in revenue in year three. They were pre-product, and this is, a first-time founder, etc. This is completely delusional. And I see that, close the deck, next, right? So you want to be in line with industry standards. And honestly, when you're at early stage, you don't know what the numbers are going to be exactly in terms of forecast, but you want something that makes sense. So we know, okay, the first 2 years, you should triple your top line, right? So 1 to 3, 3 to 9. The next 3 years, you should double. So 9 to 18, 18 to 36, 36 to 72, right? It's a bit mechanical, right? But these are the kind of, if you spend a bit of time in the VC space, you will see those patterns, and people start to just take that for like, okay, this is the standard, this is what I expect. So if you're too far off, if you're too high or too low compared to this kind of trend line, it will create suspicion. And maybe it's unwarranted, maybe you're right, but it's just because people have habits. So you want to have that nice curve that goes like this. Um, And yeah, you want to try to mimic the well-known trajectory of a tech company going toward IPO, 7, 10 years from now. So that's the kind of message you want to send. That's what your financials should show.
and the financials, a typical P&L, cash flow, balance sheet. Is that the standard set you would expect in a pitch deck, Steph?
So, depending on the stage,
Yes.
uh, if you are very early stage, angel round, pre-seed round, you can get away with a very rough, cash flow table, because cash is really what matters at the end of the day. Can do maybe, monthly for the first 2 years, and then quarterly or something like that for the next three. What matters, honestly? Okay, so here's the thing. In the first deck that you're sending to investors, just give a very high level view. You maybe don't even need a financial slide if you're pre-seed, right? But once you get into a conversation, they're gonna ask for some spreadsheet. Again, doesn't have to be 5 year pro forma, whatever. But what they won't see is the thought process, the drivers. They won't see that, okay, so what are the assumptions that went into building those
Yeah.
numbers? And what happens if, I mess with your assumptions? And I've known VC analysts that really enjoy, messing with your spreadsheet and your formulas and digging. Especially, I'm in China right now, and they are much more data driven, if I can say that, than Western VCs. Right? Western VCs, yeah, we're betting on the team. Chinese, yeah, we're betting on the team, but give us your financials. Still, we want to check, and they check sale by sale the formula. They are
Yes.
very methodical. So yeah, what matters honestly it's not so much about the, like I said, as long as the numbers seem to chart the correct trajectory, that's fine. And then we want to deep dive into the main drivers and kind of stress test your assumptions. If you pass those two checkpoints, you should be fine, right? As long as those two things make sense. It's not, I mean, it's not a CPA exam, and you're not going to be challenged on, I don't know, the construction of your margin or whatever, or the tax optimization.
Give an example, Steph, if you may, on the key drivers, because I hear exactly what you're saying. Key drivers and unit economics that at the unit level there is
Yeah,
the business can make money, and it's amazing how many founders and young entrepreneurs don't know that how the business really makes money. But it's important to show the unit economics. But give an example of the key driver because
sure.
that's absolutely
Okay.
the foundation of the assumptions, you know?
Okay. So to make it super simple, there are a few numbers in your spreadsheet. So you build a spreadsheet, you build a financials. There are a few numbers. If you move them a little bit, they will have a big impact on everything downstream. So these are the things that we want to test. One example is customer acquisition cost,
Yes.
right? So we say, okay, I'll take one example because it's fresh in my mind, a dating app. You know, people like building dating apps because it's a market that everybody kind of understands a little bit and is familiar with. Technically, it's fairly doable. It's not too challenging. There's no big challenge. It's vanilla software. What people don't always see is that dating apps is just a game of customer acquisition cost and lifetime value of customer. That's
Yep.
it. It's how much it costs to bring one person to the app and how much they're going to spend, and that's it. That's the whole conversation here. Kind of the concept, the UX, the product of that stuff. This is really at the bottom of priorities. If you can get that mix right, you win. So now you have assumptions because your product is not on the market yet or just launched, and so we don't have enough data. So we need to make a bet based on this. And you say, okay, we're gonna acquire customers for $5 based on some Google ads or whatever. Okay, if you're off and it's not $5, it's $10, then it could potentially mess up everything downstream, and before that you were cash flow positive, you become cash flow negative. And so that's one example. And I see that a lot because, well, a lot of founders just don't have a proper go-to-market strategy because they've never done that before. So they don't think in terms of channels. They don't think in terms of acquisition costs. They don't even have benchmarks in mind for, okay, yeah, acquisition on, I don't know, acquisition on LinkedIn is like $5, and then conversion rate on the website is going to be maybe 5% for sign up and then 10% for upgrade to premium, just to take a classic B2B SaaS SMB type of stuff. So when you put the numbers together, right, you have this funnel, and those assumptions here. If the LinkedIn is going to be $5, it's pretty robust, right? This is pretty standard. Actually, it's maybe a bit high. But let's say that the conversion, the upgrade rate from free to paid is not 5% or 10%, it's 1%, right? So like the whole thing collapsed on itself. The whole construction now is losing money every day at an incredible rate, and you're dead in the water. And the investor who put their money in your company is dead with you, right? So this is the kind of stuff. Lifetime value is another one, right? Because, okay, people are gonna that's a classic one because very often you know that people buy or upgrade, but you don't know how long they're gonna stick because your company hasn't been around long enough, so you don't have enough historical data. And so you're like, okay, people upgrade on average X%, and we charge $99 a month. And we're guessing they're going to stick with us 24 months on average before churning. Actually, they say 8 months. And yeah, uh, you
Ah,
can, yeah,
you can take it
it's
right
it's
now.
it's over. It's over. So this kind of stuff that hurts, and it's honestly there's no great answer to that because until you've done it, you don't know.
Absolutely, Steph. And this leads to, any investor will ultimately want to know, and those are the key drivers, will ultimately want to know what's the burn rate of the company, how much cash is being
Oh
burned
yeah.
every single month, right? And where does it go? So it's important to kind of understand how much cash is going out the company because you'll have minimal revenue, I assume, in the early stage. And then the second thing is the turn to break even. All
Yeah.
right, when does it actually turn to positive cash flow, so to speak, and even recovering the initial investment. So your key drivers, as you say, you've got to start to kind of build a history behind this thing. The key driver assumptions are critically important. There'll be some sensitivities with that, as you mentioned, Steph. The investor group will probably do their own little version as well to kind of
Yeah.
battle test the assumptions and the reasonability. And then, of course, understand whether they want to invest or not. But ultimately, they're trying to understand what the cash flow dynamics of the business are, because that's what drives the
Yeah.
valuation, the ultimate ROI. Well said. Thank you for that, Steph.
Oh, well,
Okay,
thank you for I mean, you actually said the most important thing, and I completely forgot. So thank you for reminding all of us we live and die by cash flows.
exactly, exactly. Okay, visual appeal. So, what are the best practices, Steph, for designing a visually appealing yet professional pitch deck?
Uh, so a lot of founders, okay, here's the thing. We are visual animals.
Yes.
Human beings, we are visual animals. We love pretty stuff. And even when we claim we don't, we do. Okay. So a lot of founders will say that no, it doesn't matter if my deck is ugly because the content is great. And anyway, investors should be smart enough to find the diamond in the rough. I hear that a lot.
Yes.
And even investors, sometimes they'll tell you, again, because they are proud and wrong, they'll tell you, yeah, no, it's like people who say, I'm immune to advertisement. Same thing, yeah, I'm immune to design. I just pay attention to the content. That's not really true. Again, with visual animals, if something is pretty, has a lot of like, how do you say, a negative space, margins, alignments, fonts, readability, hierarchy of messages, text density. I mean, there's so many things, color palettes, alternating layouts. There are like dozens of simple design rules that you can follow to make your deck pretty and pretty sells. Okay. That's why people buy Apple and not another brand that maybe has better performance, but doesn't look as good. So having said that, so that's kind of the first point. Like if you disagree with that, you can ignore what I'm going to say next. And I know some founders will stick to their guns, but I think just understand that your deck is a marketing material. Okay. Fundraising is sales. Your deck is marketing material. And by the way, so that's a funny one. Talk to founders and they will really spend a lot of time, a lot of effort on their website, right? On the homepage for conversion because they want people to understand the message immediately. They will, A/B test the color of the call to action button. Is it better blue or green or maybe red? You know, they don't even have enough traffic to A/B test in a statistically representative manner, but they will still do it. But when it comes to the pitch deck, then and I think it's kind of anti-psychology type of thing. They just sometimes refuse to put the same effort. But you have to understand that your pitch deck plays for investors the same role as your landing page for customers, right? It's the first contact, it's kind of the window of your shop, and you really want to get this right. So now hopefully people are convinced and we can look at the best practices where there's a million of them. So number one, look at other slides, look at other decks, learn from them. If you've never been in that space, you don't know what a good decks look like. Okay. They don't teach you that in school. It's not an innate thing unless you have a design background. And even then, pitch deck design is a very specific thing. So educate yourself, educate your taste, find really pretty slides that you like and copy them. Okay. That's number one. There's no shame in copying. It's low. There's no benefit. There's no upside in creating, original design. Like find a color that you like. You like the Facebook blue, take the Facebook blue. Okay, it's proven, it's battle tested, so go for it. Same for the layouts of your slides. That's number one. Number two, use a template. There are templates. Some are free, some you have to pay for. But if you've never done that before, that's usually a good shortcut. It's gonna cost you, $20 to $100, whatever. It's a one-time thing, and it's a nice little shortcut. It helps you ease into the pitch deck creation. And then number three, it's about pitch deck designers. So this is where people have very strong opinions. Usually, some people think this is a waste of money. Some people think it's necessary. Honestly, it depends on the founder. Some founders are just good at design. Once you show them some examples, they can do a good job. Or sometimes they have a background in consulting or in marketing, so they're used to that. Other founders, honestly, they have no graphic taste. I just have to say it. It's because it's reality. It's like saying some people are tall, some people are short. Same thing. We're unequal in visual taste, and so in that case, you might want to hire someone to help you. It's not gonna cost you, thousands of dollars. It doesn't have to. You still own the deck. You're still responsible for the outcome. You're still responsible for the message, for the content. That is not something you can outsource. Nobody can care as much as you care, and nobody can tell the story like you. But once you have all the blocks in place, maybe hand it over to someone who is a professional who will do, in 8 hours what you could not achieve in 8 weeks and give you a good looking deck that looks professional and that conveys the message much better. So that's my opinion on the topic. And after that, I know I get always, I get bullied in the comments, but what can I say? That's life. I do believe that looks matter when it comes to pitch deck.
Of course, I'm in your camp as well, and I think it's a fair points there. Steph, just take a little bit further. One or two, maybe three fatal mistakes when you're looking at 150 decks per week, Steph, and you look at one for 5 seconds and you put it down.
Yeah.
Why?
Oh, by the way, it's 300 now. We have grown a little
Yeah.
bit
Oh, wow.
since.
Congratulations.
I need to update. Yeah, thank you.
Well done.
I need to update.
Congratulations. Well done, Steph.
Yeah.
That's awesome.
Thank you. Thank you, Richard. So, okay, the cover. I open, first thing I see is the cover. Um, if I mean, uh, it's it's like a circus. There are so many ways to be wrong,
Yes.
so many ways to shoot yourself in the foot. I don't know where to start. So I'm just gonna list a few ones, but there are many more. Okay. Number one, the number of slides. I used to run something called pitch deck roast. So I invited a VC on a call, and I brought three real pitch decks of three startups who agreed to that. Of course, we asked them before. And live in real time, the VC would tear down the deck and say, "Okay, I don't like this, don't like that." It was fun, right? It was in good spirit, but also a bit, aggressive. And um, and the first thing the guy did, so this was a very, very reputable investor. You can find it online on YouTube. He looks at the number of slides. You have one slash, 38. If it's more than 20, the guy is already, come on. I have 20 decks to review today. Then I have to go to paddle or I have to go for drinks. So, 38, I already know I'm not going to finish it, right? But also think about the message you're sending. And this is true for anything related to design. You're telling investors, you have no emotional intelligence. You have no empathy. You don't understand human psychology. You don't value the investor's time. You don't know how to prioritize information, right? You don't have any marketing skills because you know a proper marketer would know that and would keep the deck, 10 to 15 to 20 slides if you really have a lot to say. So number of slides, right? It's a small giveaway, but I swear, the thing is when you have to review, 300 slides or 300 decks per month or per week, you develop patterns. You're not reading the deck. You're just trying to find red flags to eliminate as fast as possible. It's like factory chain. So And founders really don't get that. A lot of founders, and I'm talking about first-time founders doing that for the first time. Obviously, after some time, you understand the rules of the game. But first-time founders, they don't get it. They think we're going to read, right? No, we don't. It's just a litmus test. Can you pass the litmus test? So one of those things is, are you going to give me a 50 slide deck? If yes, it's probably not good. Then the text density is number two, I think, right? People who cram as much text as they can in a slide, and it looks like, I don't know what it looks like. It's just not something not something you want to read, right? And the crazy thing is, people know that because when it's for them, they wouldn't read it, but they expect someone else to read it, which is so funny, right? Because give them something like packed, cramped like that, they would not read it. And just look at advertisements on the street. You have like three words, right? Just do it. I'm loving it, right? With a big image. That's what works. We communicate with images, we communicate with colors, just a few words, you know, and that's what you should aim for. So I guess at the end of the day, it's a matter of self-awareness. And yeah, at some point, take two steps back and look at your deck with a critical eye, and you will see all the flaws. There is one of my old boss when I used to work at Microsoft. He used to say that. So I worked at Microsoft Accelerator, so still startup stuff. We saw hundreds of decks, and he was a former VC, and he said that founders see their companies as a baby. It's their baby, right? And so people always think that the baby is not ugly. Talking about design. Yeah, my baby is the prettiest baby in the world, right? So and you're like, yeah, okay, and they show you the photo, right? They show you they have the look, it's my baby. It's ugly,
Yeah.
right? But yeah, and so it's same with your pitch deck. You have to take two steps back and understand that it's a market, there's competition. You're one of many, so you have to just look at it with a cold eye and say, okay, look, yeah, the colors are all wrong, the fonts, the text density, the number of slides, nobody cares enough. And then understand, and it's going to be the last thing on this topic because I'm talking too much. Um, it's a process, you know. Um, if you if you like someone on the street, you're gonna say hello nicely, and then if there's interest, maybe we can chat a little more. Okay, if there's interest, maybe we can exchange phone numbers, and then maybe go for coffee. It's a process, right? We don't get married on the first day. It's the same thing here. You will not communicate all of your vision and plans and hopes in the first deck, right? You will just communicate a decent amount of information, reasonable amount of information. Okay, this is who we are. This is what we do. This is our success to date. This is where we're going. Want to chat? Yes, no. And you keep a bit of mystery, right? Keep a bit of information, like the meat of the topic. Keep it for later. And then if they want to go on a date, okay, we go on a Zoom call and we get to know each other. Okay, so you mentioned stuff about the product. Tell me more. And maybe now I want to see, your 10 screenshots or your 10 mockups of the product. Maybe I want to see all your dashboards and all that stuff. But don't force feed me, Don't stuff my throat with all your materials on the first contact because it's just not a human way to interact with people. And a pitch deck is just that. It's just a medium to communicate with a third party. So don't stuff your deck down my throat, basically.
I love that, Stefan. And you certainly weren't talking too much. I loved I listened because this is the crux of great pitch decks, right? There's certainly an emotional awareness and self-awareness aspect to this, right? But
Yeah.
100% because this is a human process. All right, you're putting it down on paper and it's marketing and it's pitch deck and it's numbers, etc. But this is person to person. Someone at some point is going to have to cut a check to you, and so the relationship is very important. So I love your analogy of dating. It's 100% that. So thank you for that. That's great advice, Steph. Thank you so much. Um, so addressing risk and scalability. Um, you know, as a finance executive, I've seen hockey stick decks, and I've seen people talk that they're going to change the world and be the first person to enable world peace and all this stuff. But in my mind, as a person who cuts a check as well, whilst you don't want to douse the deck with negativity and risks and all that kind of stuff, how should businesses address potential risks in their pitch deck without deterring investors?
That's a good one. Um, so what I've seen founders do sometimes is they have a slide where they kind of try to diffuse objections. So they're like, okay, they have a slide with like, okay, and actually this slide is a very typical layout. I don't know, I guess someone did it once and then it kind of spread, where they have on the left four horizontal arrows,
Yes.
where they say, okay, risk one, risk two, risk three, risk four. And
Yeah.
then on the right, mitigation strategy
Yeah.
with
Yeah.
four arrows going the opposite way to say, okay, we know there are some, weaknesses or threats, and but we are aware, and because we are aware, we can mitigate them. And I guess it's also a bit the same thing when people do those SWOT matrices, trying to say, okay, yeah, we have a holistic view, balanced view of this. I don't know if I'm a fan of that, to be honest. The SWOT, I definitely wouldn't do it because I feel like it doesn't belong culturally to a startup pitch deck. It's more of a, McKinsey type of thing. So I just wouldn't. Um, so that's one thing. And this other thing, I don't know, because I don't think so. I think it has two flaws, this approach. Like, I understand the desire to approach objections head on and be upfront with that, and I think it's commendable. I would not put it in writing in the deck that way because one, it would not fit any thread. It would not fit into a story because you would have to interrupt the story to just talk about the project from a kind of yeah, corporate executive point of view. Think, okay, there are those threads. Like this would break the narrative. So I wouldn't like that. And two, what I see sometimes when people create those slides, they feel they have to fill the four arrows. And so they dig to create problems that don't really exist, or they just don't prioritize them well. They put really important stuff, strategic stuff, next to very secondary stuff just because they feel I need four arrows, whatever. I think this is I think this is the kind of stuff where if you're, at least at early stage, if the project is designed and thought out well enough, um, well, maybe there's a problem for a specific target, but it's not our target, right? Um, maybe there is a, well, so because what type of risk are you going to have? If it's real technology, there's always an IP or just a technology risk, it doesn't matter. And then the other one on the market side is going to be an adoption risk. I say, I guess, and I'm thinking out loud, so I'm not
No,
very,
actually, no,
I
it's
didn't
an important
prepare
question.
that question,
No,
but
100%, Steph.
I,
Take your
I'm,
time.
I'm, yeah,
It's an important question.
yeah, it's an important one. I feel that this is something you want to address like professionally in person, right? In a
Yep.
conversation,
Yes.
because you want the person to kind of bring up the issue and you can answer it. As a conversation, as you know, a professional speaking with another professional about how to crack a business issue. That's or how to approach a business issue. So that's one thing. I wouldn't put it in the core of my pitch deck. I would, however, have it as an appendix slide when, post first meeting or at due diligence, if there is a specific risk, I would maybe have a kind of focus, zoom on that risk on one slide, and I put that in the appendix, right? Not in the, I don't want to break my, like I said, my narrative, But as an appendix, like, yeah, how do we mitigate the technology risk? So I can give you one example. I worked with a company developing a new battery technology, electric battery for
Yeah.
cars and stuff like that. And so this is, I mean, this is heavy stuff. There is real research. There is a lot of IP. There is manufacturing. And it's an industry where it's all about cost, and performance. So everything is quantified. So the guys had one chemistry that performed at certain levels that were really good. And then they were working on a new chemistry, generation two, that were supposed to be even much better. Okay. So the question, of course, is chemistry two going to work?
Hmm.
Because if it works, then it's the bonanza and it's fantastic and it's amazing. Otherwise, they're stuck with chemistry one, which is still good, which is still, state of the art, but it's not the same technology leap, right? Yeah. And so uh, they never discuss that like I said, in the core of the deck. But they did have, for example, several scenarios in their financials, right? Base case and worst case scenario. Okay, we have to just build with chemistry one, so this is what the forecasts look like. Um, I think that's acceptable. If there's one or two important risks, maybe you model them. But again, you don't want to suggest or hint that. You want to be ready, have some backup slides, have answers for the conversation. But other than that, you have to, give a confident front. And yeah, I would probably do that.
Okay. All right. No, that's fair. And as you say, look, this is a fluid process. There's really no right answer, Steph, on this stuff.
No.
And I think it comes down to, again, knowing your audience because, you're going to have some investors around that table who are probably more conservative than others. Others who are a little bit more, you know, thinking about the risk profile and a bit more
Yeah.
adverse now to, hockey sticks and so forth, just want some level of balance and reality.
Yeah.
So,
And you cannot convince. You cannot
yeah,
convince. Some people, if they want to find risk, they will find risk. You cannot convince them. If they're not convinced, honestly, and maybe that's why there's no answer. Because if they're not convinced by the team, the traction, and whatever you have going on, if I want to bring up, oh, there is risk A or risk B, yeah, sure. What if Google launches a competitor next week? Yeah, sure. What if you cannot raise the next round? Yeah, well, of course, then we're dead, you know? And so we cannot, you just have to accept that, okay, some people, we're never going to convince them. The risk's never going to be right for them. Um, that's usually because the team or the traction is not there. That's usually what's happening. Like the risk that they bring up as an excuse is just a pretext.
yeah, I understand. Understand. Okay. All right. Let's talk a little about scalability, and then we're going to go to the call to action and the final advice here, right? So
Hmm.
we talked about scalability, Steph. So what's the most effective way to present the scalability of a business model in a pitch deck?
Okay, so let's start with defining scalability, what it means. So that is that you can scale up
Yes.
so that the startup can grow fast. And usually embedded in that idea when we talk with venture capital investors is that it can grow fast without burning too much cash. Because if you have to burn, so just two examples. One example, Starbucks. Starbucks is everywhere, right? So it's very scalable, but it took them a long time to get there and they burned a lot of cash because they need to open locations. It's a physical business, blah, blah, blah. On the other hand, you think about something like, I don't know, Salesforce, Slack. Slack was a good example, right? Once they found the product market fit, they grew very fast.
Yep.
And they did spend some money, right? They raised funding and stuff like that. But when you compare it with the scale, it's still very reasonable, right? The number of customers they can serve versus how much they burnt in cash. So this is really these are the two axes of scalability: how big you can grow and how fast for what amount of resource. time
Yeah.
and money. Or at least that's how I like to think about it. So you want to demonstrate those two things. So you want to demonstrate that you can grow fast, which brings us to the market size. There is a large market. And you want to show that you can do it without, um, burning too much cash.
Yeah.
So some business models are better for that, right? A software, especially subscription software, is great. Anything where you can get the cash before you have to pay your suppliers or whatever it is. So insurance is great, right?
Yeah.
For that, you get a lot of cash up front.
Good.
I think it was like a few days ago, some guy in InsurTech was asking something on LinkedIn under my post. I post a lot on LinkedIn. And I was about to reply, and someone replied before me, man, you're insurance. You don't need to raise. Just get some clients through the door, get their money, and your life. Of course, it's oversimplified, but that's the kind of mechanics going on. So yeah, that's pretty much what you want to show. You want to show we have um, a product that has a low marginal cost or zero marginal cost, right? And in a large market. And then the last point might be the distribution. So we have those 2 points, but then going from A to B to C, right? Climbing the stairs, it's going to be distribution. If you can distribute direct to consumer, for example, and if you can prove that this channel works, it's great. If you have to go through partners, well, it's going to take a longer time to build that partner network, maybe, or maybe not, because if there are a few strategic partners that can just distribute you, that's fantastic. Think about Teams, Microsoft Teams, right? Uh, they piggybacked on Microsoft's, existing installed user base and just distributed Teams everybody to everywhere. It's unfair for Slack, but distribution is very important. And so that's how you can be extremely scalable, insanely scalable if you have a distribution advantage. So I think Teams is a kind of textbook example of hyper scalable product, right? Um, it was very cheap to relatively, all things being equal, very cheap to scale, insane distribution advantage, and very large market because everybody wanted it. I mean, in that corporate space, um, because Yammer and stuff didn't was not good enough. So yeah, that's it.
Wonderful. Wonderful. Okay. Last couple of questions here, Steph. You're doing a great job. Thank you. These are some fantastic wisdom bites. So thank you. Um, all right. So how can business craft a clear and compelling call to action in their pitch deck?
Call to action. Well, the best one is the best one I've seen. True story. Actually, it's public. You can find it on Open Deck. It was it So Rare? I think it was So Rare, French startup in let's say crypto blockchain. And the guys on the pitch deck, they were like rounds, closed, oversubscribed, and they were just gathering some final checks. But they had their, I think their previous investors were investing because they were doing super well. And so they were raising funds, and on the ask slide, they were, okay, we're already full. So I think that's the best, right? The best signals, because the three things investors really want is one, track record. Okay. Exited founders or proven founders, you've done great things in the past. Two, traction, growth, retention, usage. We discussed that, J curve, hockey stick type of thing. These are the two important things that differentiate you from the pack. But then three, that other investors are investing, and so I can just follow, and it's a no-brainer. Maybe it's a wrong decision, but it's a no-brainer. So yeah, and so from that point of view, what Sorare did, I think it was Sorare. You can find them on Open Deck. Yeah, that was really cool. That was really also a power move, like, hey, we don't need you. If you want to invest, yeah, sure, why not? Let's talk, but we don't need you. And I think that's the one. We don't need you. That's the thing. It's you. We talked about dating, right?
Yes.
Have you heard of the concept of negging?
I've not. I've not.
Okay, you haven't. So,
I've been out of the dating scene for 35 years.
all
Stefan.
right, good
Married.
for you. Good for you. So negging is when you uh, tell a woman, I mean, it's typically a man to woman, a negative compliment, I guess. So not a compliment, something negative. Uh, and it's some kind of, anti-psychology to get the opposite reaction and get her interested, right? It's obviously it's very lame and it's very cringe,
Yeah.
but I think it works really well with VCs. You know, you make them feel I don't need you,
Right.
right? I don't need you. And of course it should be true to some extent
Yes.
because as in any negotiation, you only have as much leverage as you're ready to leave the table. Um, but yeah, I don't need you. I'm good, right? You want to invest? Sure. We can get on a call, but I'm not in a rush. And that works really well. That works really well because then they want in. They want in.
They're
Are you
right.
raising? No, no, we're not raising. Maybe we're raising in 6 months, 12 months. We'll see. For now, we're profitable. We're growing. We can sure keep in touch. No problem. I can put you in our newsletter if you want. You receive updates every month. This is how, experienced founders who don't need the funding and play that game, right? But that's a different category. But if you can give some of that vibe, that's not bad. Um, that's what that's what a lot of scammers do actually. All those people, Theranos and the other guy, forgot his name, who went to jail recently. Um,
FTX, not the F.
yeah, yeah, yeah. Right? Playing video
Ah,
games while pitching VCs,
yes,
right?
yes,
Like being arrogant,
yes.
being insufferable. Have you seen the Silicon Valley TV show?
No, I've not. No.
You have to. Season one. Watch season one at least.
Wow. Okay.
Um,
Do that.
you have to. It's really good. And there is a segment called Negotiating with Rudeness and Hostility, where they go on Sun Hill Road, pitch every VC, and they realize the more insufferable they are and the better term sheets they get. And it's a masterpiece. It's like a 3-minute segment. I'll send you the link after the podcast, man. It's so good. It's so good, and there is some truth to it. So negging VCs done well is not a bad move at all.
That's interesting. No, that's
But
interesting.
you didn't get that from me.
No, of course, Steph, I didn't get through. But equally on the other side of the scale, Steph, I have seen pitch decks where there was no call to action. The pages turned and there was nothing at the end as to what they wanted. So equally important. I understand
Yeah.
point about, if you're in a position and you want to take the approach of a bit of a mystery man and whet the appetite of the investors, but also I've seen others where nothing. So what exactly do you want? What are you looking for, right? So
Yeah.
we can't forget that point.
Oh
Oh,
yeah, there needs to be an ask and there needs to be the email address of the CEO. Right. Last slide. Contact us, richard@superstartup.com. Right. That's a must have, non-negotiable.
absolutely. All right, final question, Stefan. This has been superb. This has been superb. What are the most common mistakes businesses make in their pitch decks and how can they avoid them?
Okay. If I have to just keep one, I would say they don't do their homework, which is my way of saying there's a million little things and you have to prepare for it. A lot of founders don't realize building a pitch deck is a lot of work if you've never done it before. For me, if I had to create a pitch deck now for any startup, like content, I could probably get it done in 2 hours and it would be pretty solid. And then I know a solid designer in Turkey, great guy, good price, super active. So the deck can be done, in 24 hours. But that's because I have 10 years of experience. Um, but when it's the first time you do it, it's gonna probably take you, a few days of iteration, probably much, much more, right? And the problem is that you want to go and raise and you don't want to be stuck because this is a bottleneck, right? That's the problem. It's a single point of failure, kind of like until your deck is out, you cannot start raising.
Yes.
And it's so annoying because it's so, you have this big vision, you have a million things going on, and you have to do these teeny tiny little things and review the copywriting for the third time and ask yet another opinion. Someone tells you to do the opposite of what the guy before told you.
Yeah.
So it honestly, like there's a psychological aspect to creating your deck.
Yeah.
We don't talk about that. There's a psychological aspect, which is it's the most annoying thing to do at the time when you least want to do it.
Yes.
And so you should, well, if the first thing you should do is listening to your podcast and hearing that and knowing that, okay, I'm going to need probably more time than I expect. And I should plan that time, So if I want to start to raise in January, prepare my deck in December 1st, I start building my deck. Maybe have a little bit of budget, either for a template or for a designer or something like that. And then save some time to review existing slides, like I said, read some tutorials, and educate yourself on the best practices. Because again, it's kind of a sport on its own with its own rules. And if you want to play League One and you're a baby player, like it's not gonna go well. So you need to get up to speed and climb that learning curve real quick. So yeah, do your homework, budget enough time and resource, and it will be fine.
Awesome. Steph, thank you so much. This has been a superb, close to 90 minutes. Has been a treasure trove and some golden nuggets from here, man. I know you see a lot of pitch decks during the course of the week. It's doubled, as you mentioned. So congratulations on that. I know OpenVC are doing some great things, and what a wonderful business model. I see your posts and all the activity you got going on, to help the general public, come up with the next best idea and pitch it as well. So thank you for all the things you're doing for the population of new entrepreneurs and starters and founders. So well done on that, and thank you for your time. This has been superb, Stefan. This is exactly
Thank you, Richard.
extremely valuable, information here and takeaways for newbies. So thank you.
No, it was great experience, super pleasant. So thanks a lot, Richard, for having me.
All the very best as well. I know it's in the evening there, and I'm sure it's getting late, but thank you for your time as well, Steph. You're very gracious. All the very
Thank you,
best.
Richard.
All the best. Thank you.